Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Thursday, August 15th, 2019. It is 1:19 p.m. Eastern Time as I'm starting the video. And there's not a lot new to report, but it's been kind of quiet today, so I figured I'd get a video out. I also wanted to make mention, I'm going to step out for a brief appointment today. It's a 3:30 appointment, so I'm going to be leaving just after 3 and back right around or shortly after the close. So therefore there might be if anything big happens into the close and I don't have access, at least on my phone, during that time, I'm not going to be able to post anything. But with that being said, let's go over the charts, levels to watch, and some considerations to make going forward here. All right, I'm going to just do, because there's always new people coming in the site or members that don't maybe actively follow the markets, check in from time to time. So I always like to keep an eye on all time frames, and so this is the bigger picture right here. This is about as far out as I go. You can go to, this is a monthly chart, by the way. It spans all the way back for decades here. You can see into the early 90s. But what I'm focused on primarily is this uptrend line. So here's our bull market. And the NASDAQ, which actually started back, NASDAQ bottomed in November of 2008. Every other index bottomed in March of 2009. So that's really when the bull market started. And you can see it's a very well-defined uptrend line. And again, most bull markets have comparable or similar uptrend lines. Not all of them, but most of them do. About the only one that didn't was the dot-com bubble, because that was a parabolic market advance, parabolic tops. You had really a series of steepening lines. You need a parabolic curve to get that one. But this is the current bull market right here, and you can see we're flirting with the primary uptrend line right now. Thing that I've covered in the past too is this 20-period month EMA. So it's an exponential 20-period exponential moving average. Each of these candlesticks are monthly, and it just does a superb job of defining bull and then bear market. So when you cross below it, it's a monthly chart. Only thing that matters here is how we close the month, but typically you can see that was the you're looking at the dot-com bubble back in 2000. Some of you may not even have been around or at least trading when that happened. That was followed by a vicious bear market, and then the next bull market, which ended in 2007. There's the Great Depression, the crash. That was a 50-something% drop. So don't let that little blip fool you. I'm using log scaling. It's just relative to this one, which up until that point in time was the longest bull market in history. This one just recently beat it. So they're about comparable. And again, I wanted to just point out here, these are things that I'm watching, haven't triggered yet. You can see how well the 20-month defined the bull market. What I mean by defined is prices are above, and then like any level, it acts as support on pullbacks. And then once you break it, you can have some whipsaws. That's common with any especially moving average pairs. But once you had a solid red candle down through there, you can see at this one, I tried to circle it. Here, I'll zoom in a little bit tighter for you. Remember, again, 2007 top in October of 2007, and you finally had a big red candle. You started to get cracks right here. This is what I call the shot across the bow. We had big correction before or right after. That was in January, and snap back up on the kickback rally. Bear market rallies can be powerful, but we fell shy of the highs, and then boom, that pretty much sealed it, because you had a monthly close way below the trend line, and the rest was history. And again, that was over a 50% drop from top to bottom right there. Okay, since then, we bottomed, as I said, and these long-term trend indicators, they're not going to get you in at the bottom and out at the top because they're slower moving averages, and this is a long-term chart. But once we started the bull market, you can see it did great. Here's examples of why I always say, use closing candles on whatever time frame you're trading. So if it's a monthly chart, it doesn't matter. That was a flash crash back there in QQQ, a mini crash. There was a big drop in the markets, but we had a drop. But you can see we snapped back. All those candlestick bodies, the fat part, closed back above that line, and that's all that matters. You had a brief little whipsaw here. So that's one big level, and the fact that it comes in with this well-defined trend line is even all the better. And then, of course, the divergences tell me that level is most likely to go sooner than later, because now we have divergences for the first time throughout the bull market. or I should say, first time we've had these divergences now building for the last year or so. So there it is. So this point is we're still pending a long term. These are my longest term trend indicators right here, and they remain bullish for now. But the market's in a precarious position. Like I like to say, support is support until less broken. And at the very best, we wouldn't have a sell signal there, at least a break of the trend line and a close down below it, or that 20 period monthly EMA until the end of this month, so a couple weeks there to go. And of course, I'll update that if and when that time comes. Wait, one more thing before I go to SPY. Yeah, the rate of change 12 does a very good job also. Like I say, there's not any perfect indicators out there. If there were, this would be so easy. We'd just use them, sit back, and everybody would be rich, right? So, but it does a pretty good job. ROC 12, rate of change 12. When the histogram, when the bars are green, when it's above the zero line, that gives you the green bars, you're in a bull market. And when it crosses down below, you're in a bear market. So you see a few whipsaws along the way. Sometimes I'll play around, make that, change it to the setting to an ROC 12. But you can see we had a little shot across the bow there, and then boom. And again, this doesn't look like a lot, but that was caught the bulk of the 55+% drop in the NASDAQ 100, and even the S&P fell over 50% in that last bear market, and so it warned it. So we're starting to, we have another one firing potentially this month. We had a little whipsaw there, a couple whipsaws here. This was actually, I believe the Qs dropped over 20% or very close to it during that correction back or 2-year sideways market back in 2015, 2016. So again, it's a pretty effective indicator. But once you start seeing consecutive bars and those bars start going deep, you'll know you're in the next bear market. So we're not there yet. Maybe soon, maybe not. We'll see. SPY, same thing, going back long time. Monthly chart again, this is what I'm going over right now since it's a slow day in the market. We'll get to some of the nearby levels. Wash, rinse, repeat. You know, looking back, going into the 80s, you only see on here, and I could be wrong, but I've looked at this chart. I don't believe I missed a single one. I'm not trying to just confirm the case that I want to make here. You look back, and for decades now, you've had 1, 2, 3, 4, 5. This is really an extension. This is one. If I say DH1, DH2, it just means that you had a divergent high and then a correction, which played out for a roughly 20% drop already, and you pushed up and extended those divergences. So I still have that number will change because we went a little higher, so there's more than 25% from the highs to my target. But again, the point I'm trying to make is, without fail, all the bear markets in going back for decades have all been preceded in the S&P 500 by these divergent highs on the monthly chart. So if nothing else, a takeaway here is I did a kind of dug in, did a video update on some of the day trades I did recently. Same premises. I was using negative and positive divergences, trend line breaks, support levels on the 1 and 2 minute charts to actively day trade during this volatility. That's when I kind of put on my day trader hat, and normally I'm a swing trader by, that's my primary trading style. But the point I'm trying to make is 1 minute charts, 5 minutes, 60-minute charts daily, the same principles and the same tools you use for trading technical analysis work just as well in those longer term time frames. The thing is, they take a lot longer to play out. So if I've been warning of these divergences in a bear market for a long time, that's because they've been building and they've been reflecting now in the chart for going back for years, a couple years. So they played out certainly already for a bear market by that definition. A drop, NASDAQ fell over 20%. Everything fell about 20% or more, all the indexes. But again, the divergences warn of a bigger correction coming, our bear market out there. ROC 12 starting to roll over, cross down into red territory. Again, the month isn't over, so there's work to be done. And again, the trend now on the S&P 500 or the SPY, I have it coming off that body right there, the fat part of the candlestick bottom in March of 2009, coming in here. And if you look at the yellow line, basically what we did is SPY broke down and is currently back testing that trend line from below. Big red candle right there, bearish candle on the monthly chart. So that's the bigger picture. Now let's just take it down a notch and look at the weekly chart. So what I'm doing here is stair-stepping down on the time frames, because the shorter you go on the time frame. So here's the way I view trading, whether it's investing, a position that I'm going to hold for months, maybe years, or swing trading. I like to take a top-down approach on the time frames. Confirm the larger trend or likely trend reversal if that's coming out on the larger term time frames. But then, as I just told you a second ago on the monthly charts, you have to wait for that, today it'll be August 31st this month. So you have 2 more weeks to go, or a little over 2 weeks before you finalize the monthly candle. Now, so what happens if the market tanks, drops 10-15% in the next 2 weeks? I've seen it before. And if that happens, then you've missed the bulk of the move, and it's probably too late to short at that point because you're probably going to come up on resistance. You'll be very oversold. So my point here is that I use the larger term charts to formulate where things might be going, but then I hone my entries down by going into the daily and even 60-minute and other shorter term intraday charts. Because if you have a bearish setup on the weekly, for example, and then you can align it with support or a bearish chart pattern on the 60-minute chart, that 60-minute chart might get you in early on the short entry, and then if that starts to play out, then you'll have the sell signals confirmed later on the daily and even weekly charts. So where am I going with that? There's a minute ago I showed you the SPY on the monthly had broken down and back tested. So there's your breakdown that happened last fall. We made a marginal new high on the S&P 500. We had a breakdown back test, the big drop there into the December lows. We've come up, back tested the trend line, and we're moving a little bit lower. But this is the line I'm focused on right now. Right here we have this uptrend line off the December lows. It's the same one I showed you on the daily chart, and just like on the daily chart there, you had a breakdown and a back test. So that's the story of SPY right now on both the daily and weekly. We've recently made an impulsive break, but we're back testing that trend line from below, and it again sees negative divergences which are confirmed on the weekly and daily chart that tell me more than likely, gives me a pretty high degree of confidence, regardless of the zigs and zags, and there's going to be consolidation days along the way. That's what's going on today, I believe. That is part of any correction. You do not fall forever. There's always going to be kickback rallies and consolidation days where you move sideways. So I'm still viewing it as such. If we regain that trend line, that would be one thing. Before we leave this page, I want to just say these trend lines they're valid because we had a few reactions. I've talked about that recently on the daily charts, but they're not the most valid. What do I mean by that? The more reactions you have on a trend line, the more valid it is, in my opinion. So for example, here's that long-term bull market trend line, goes off to the left of the chart here, down to the March lows. Reactions, reactions, reaction, reaction. These are all weekly candles too, by the way. And then once we broke it, you had reactions from below. And if I tweak it like this, we hit it and had another reaction from below right there. So that's what I mean by that. So there, it's there, and it's certainly worth watching because it was validated on the daily chart. We'll get to that in a second as we're working our way down. And then QQQ, just as I showed you recently on the daily chart, has currently, it fell to last week and successfully bounced off a comparable trend line off the lows. So this really needs to go, and because QQQ is, even though it is not the stock market, the S&P 500 is, if anything, closer to being the stock market. But again, the S&P 500 is only 500 companies, and they're all large cap and mega cap companies. It doesn't represent or include all the small caps, which are, quite a bit. The Russell 2000 small cap index has 2,000 stocks. But if you're going to look at any one gauge, the S&P is very indicative. It has 11 different sectors. But QQQ is heavily weighted in the top heavy tech stocks, so that needs to break. And the tech stocks are also the highest component of the S&P 500. So really, and they're going to move very similar. You can overlay the charts. QQQ will overperform S&P 500 on the way up in a bull market, bull trend, and it'll overperform or outperform on the way down as well. And hence one reason, that's my preference to trade it. But there it is. I just wanted to show you again. There's the 40-week moving average. You guys remember last week I was harping on the 200-day moving average as a key level for the S&P 500 or QQQ. You can see when the trend is bullish, the 200-day axis support. So we hit it last week. That's when I covered shorts and went long for that bounce, and it played out. We got the bounce, but we're testing it again. So that's a key level. And if it goes, we have the 200-day, which on the weekly chart, I know I'm going fast here, guys, but if you put a 40-period exponential moving average, it's the same as a 200-day moving average. Why? Because there are 5 calendar days in a week. 5 times 40 equals 200. So a 40 week and a 200 day are the same thing. So that's what I'm watching. 2 key intersecting support levels. So if that goes, I think it'll open the door for a fairly swift move down here at about that 173.50-ish level. That's pretty good support here on the weekly chart on QQQ. And then you can see some other levels there. Let's just, well, first things first, we'll see if that happens. So there it is on the daily. As I zoom down, we'll look at the, here's the official trade right here on QQQ, and then I gave you guys some targets as well, additional targets. This morning I posted SPY and QQQ targets, and I said I like to get these things out to you early because the one thing that I know from experience, and you can, if you haven't been trading or investing a long time, just pull long-term charts. Look at that. Look at the periods where you've had stock market corrections and bear markets. About the one certainty that you have is that stocks fall a lot faster. They tend to fall a lot faster than they rise. Not to say we haven't had some sharp rallies this year. I'm not saying that at all. Then the sharpest rallies usually come after the correction. This was an extremely unusual. The vigor and persistence of that rally was extremely unusual if you go back in a long period of time, especially to see it come at the end of after a 10+ year bull market. Most of those big powerful gains come after a bear market, but again, they also came after the biggest correction that we've had throughout the entire bull market. And I've said that recently, and that's another constant in trading, is that the biggest gains come during corrections and bear markets. So that's why I viewed that one the other day. That's why I was quite dismissive of that big rally when the Washington tried to come out. The White House tried to pump the markets by saying, coming out with some positive talks on the trade wars there. All right, so levels, as you can see, we're below the trend line. You want to pull it out like this. You could do that certainly right now, but then you lose that candle. So I'm just going to leave this one where it's at now. Like I said, I'm on a scale 1 to 10. This is certainly not a 10 for the validity of that trend line because I don't have a lot of clean reactions, but it's worth watching. At this point in time, I probably put as high or higher weighting on this 180 level. That's a rough target. Told you guys that before. Unofficial trades, that's around the area. And then you also have the 200-day, that red line coming in right around that 180. So again, that's what I call a confluence of support. You have not just one but 2 support levels. So if and when it goes, which I suspect it will, I think the move will be fairly impulsive down here at about that 169.50 area, followed quite likely by a reaction, not necessarily. And that will also tell us, I think if we started just coming down impulsively soon and just cut right on through there and went on down to T3, it will give us some clues to the nature of this market, and probably the clues how the next bear market, if it's underway, might look. As of now, we can't really treat this as anything more than a correction. It's way too early, or not way too early, but just too early to say that it is a bear market. Why? Because of where I started this video, those monthly charts. We're still above trend. The trend lines, we're still above those 20-month EMAs. Once those start to go, once my ROC 12 flips solidly, gives us 1, maybe 2 big red bars on the monthly close, then I will be able to say with a very high degree of certainty, nothing's 100%, but a high degree of certainty or confidence that a new bear market's underway. So we're not there yet. Let's just take it day by day. There's the levels to watch. And so the takeaway from this chart is support. Like I've said often, support is support until unless broken. We've already moved back below those gaps. I gave you that, that was my first check mark recently, or the second one. First I wanted to see The big green candle from the other day taken out, that was a check mark. Then I wanted to see the top of the Monday, August 5th gaps taken out, check mark 2. And my third and final check mark will be a break between the recent lows, a solid impulsive break and or close below there. That will take out both price support, meaning these recent lows we had from a couple weeks ago, as well as a 200-day. And that will be what I would consider my third and final check mark or nail in the coffin to open the door for a relatively swift move down to the next target there. SPY daily chart, same story really. Let's see here. That's the board. Let's look at this board. These are the targets I gave you. Again, they're unadjusted, meaning that's the actual support levels, and they're rounded off a little bit, but pretty darn close. So the story remains the same on SPY as QQQ. The next sell signal is going to come on the break under the recent lows, 282-ish. Call it. You'll know it when you see it. You'll probably, maybe at first you'll limp through, but you want to see, as I like to say, the redder the better. So big solid red candle, whether it's a big intraday candle or at least a close down below, that should give us that final check mark and open the door to move down here, where might be prudent to cover some swing short positions or at least trail stops. 'Cause sometimes in these sell-offs you hit that a waterfall sell. Waterfall type selling, margin calls are being issued on longs. They're panic selling. Their stops are being hit. People want out. Institutional funds as well as individual investors have to reduce their risk exposure, so they take money out of stocks, and that's where you get these type of sell-offs. It's just throughout time, throughout the history of the financial market, especially the stock market, there have always been and will always be sharp corrections and sharp rallies are just created by imbalances. Everything gets ahead of itself, you have a correction, and it's because everybody's on one side of the trade. Too many people bullish, too many people in the stocks, everyone's bought their last share, there's nothing left but sellers, at least for the near term. Then the opposite happens, things get a little pendulum swings too far to the other side, too many short sellers in there, washed out the weak candle longs, valuations come cheaper. If you like, the old saying, I used to be a stockbroker, and there was a joke around the office, say, if you liked Apple at 234, you gotta love it at 144. What changed in just a few weeks there, or a couple months, other than the stock dropped 38%? Did their fundamental picture change that much in just a couple months? No, not that much. Again, it's just the market overreacting. So that's that. And then last but not least, just someone down to the intraday charts. I had several inquiries earlier this morning in the trading room, maybe some on the front page, where are objective levels to short, what to look. Just go over, any of my recent charts. The more recent the better. Sometimes I will add and change levels, but like I like to say, this is technical analysis 101. Support once broken, in other words, so you had these gaps right here. Remember, that was an important level. That was resistance when we gapped down. We failed. Resistance once broken right here then becomes, you got it, support. And so we fell, we tested the gap again, which was support because it was resistance back here. Then once broken, rallied again. But now we broke it, and you can see if you zoom in tight, support once broken becomes resistance. These are 60-minute candles, and since we broke below it, we've had 1, 2, 3, 4, 5, 6, 7 candles, 6 consecutive candles, and then a 7th. Failures, all testing, boom, trying to regain 183.50, where the sellers step in, and and the shorts step in, and the longs that want to get out, they sell. That's how technical analysis works. So you have a confluence of resistance there as well, and that's what I said this morning in the trading room. Someone, asked, where would you short? Well, I said right here. This was this morning. I said we're right at the 183.52 level. Same level's been on this chart for all the way since back here. Can I promise that holds? No. And I said, we happen to break up there, then you have the next objective short here. So you can add a little here, you can add a little there. However you're managing your position, and keep in mind, the way to successfully navigate this type of volatility, to not get blown out of your shorts or feel so much pain that you can't sleep at night if you're short or if you're long and this happens. The only way to navigate this successfully, especially if you're relatively new to this or you're just not an active trader, not nimble, keep your position size small. If you're not sure what to do and you're not comfortable with this volatility or where we're going, because I might say we're going a lot lower, the next guy's saying we're going a lot higher, step in and buy. If you don't know what to do, stand aside, watch and learn. There's always tomorrow. There's always the next trade, the next correction. FOMO will ruin you. FOMO is a fear of missing out, FOMO. And if you feel you're missing out, and you're chasing, and you become bullish every time the market rallies, and you become bearish again, you want to short. That's the worst thing you can do in this type of market is, want to be long here at the top because everyone else was and the trend is up. Then all of a sudden, not here, not when the sell signals were triggered, but all the way down here when it looks like the market's never going to stop going. You want to short there, and then you get squeezed out and you second guess it. Now you want to be long again. You're going to get chopped to pieces. You're going to lose. You have to come up with a trading plan, a solid plan that quantifies your stops if you're wrong, where you're going to stop out, and that should be relative to your price targets. I like to target at least $3 a profit for every $1 loss I allow. And there's a position size calculator on the site, guys. I don't have the site loaded on this monitor right now. The little calculator icon at top on the top menu. Click on that, and you can then plug in the price of the security that you're trading, how much money you want to risk. You can play around with all the variables and do the math. And remember that QQQ and SPY, they're swinging up to and even above 3% a day in this type of volatility. And and it could get worse than that. I've seen it worse than that before. So just try to calculate ahead of time what's it going to look like. What's it going to look like if I'm right and we're going to drop another 7% or plus here from here, and what's it going to look like if I'm wrong and you're short and we all of a sudden the government comes in and takes some crazy measures to prop the market up, or the Fed. I don't see an intra meeting rate cut from the Fed, not at this point in time, but anything is possible. I'm just trying to lay out scenarios or some another positive spin on the trade wars, and that kind of news can cut both ways. There could be bad news that just takes you down as well. I'm going to wrap it up here so I can get this video out to you guys. Again, last hour or so of the day I won't be around today. As of now, it's a consolidation day. If anything big happens into the close, I will do an after hour or closing market update. Otherwise, if we don't, then there's really the same levels that I mentioned yesterday, the same developments. Nothing's changed. QQQ is, as I'm wrapping this video up, down 0.44%, which relatively speaking isn't much compared to what's done lately. SPY is almost flat at negative 0.18 as I'm doing this. So let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.